Are we witnessing the start of a major market sell-off, or just another wild ride fueled by FOMO? Today, I'll break down why both stocks and Bitcoin seem to be running on thin air and what could actually prevent a major downturn. By the end of this video, you'll know what's really driving the markets, the risks lurking beneath the surface, and the one move that could help things stabilize. Let's get right into it. If you've been watching the markets lately, you know it's been a roller coaster. Stocks have been climbing, sometimes hitting new highs, and Bitcoin, well, it's doing what Bitcoin does, bouncing between euphoria and anxiety. But here's the thing, a lot of experts, including seasoned traders like Jeffrey Bierman, are warning that this run isn't built on solid ground. So what's really holding up the markets right now? In a word, FOMO, that's fear of missing out. When prices start rising, investors worry they'll miss the next big thing, so they pile in, often without looking too closely at the fundamentals. It's like seeing a crowd rush into a store and thinking, if everyone's going, there must be something good in there. The problem is, sometimes there isn't. If we zoom out, this isn't the first time markets have been driven by FOMO. Remember the dot-com bubble in the late 1990s, or the crypto mania of 2017. In both cases, a huge surge in prices was fueled by excitement and fear of missing out, rather than real sustainable value. And eventually, the party ended, often with a painful crash. Now, Bierman and others see some troubling signs. First, the rally in stocks and Bitcoin is very narrow. That means only a handful of big names are driving most of the gains. In the stock market, it's tech giants like Apple, Microsoft, and Nvidia. In crypto, it's mostly Bitcoin and a few other coins. The rest of the market not doing nearly as well. Here's why that matters. When only a few stocks or assets are carrying the market, it's a sign that investors are crowding into the same trades. If things turn south, say if one of those big companies posts bad earnings, or Bitcoin takes a nosedive, there's not much holding up the rest of the market. It's like building a tower out of just a few blocks, sturdy until one slips out. So what's the risk? Simple. If enough investors get spooked, you could see a quick, sharp sell-off. Everyone tries to rush for the exits at once, and prices tumble. We've seen it before. In March 2020, at the start of the pandemic, markets dropped by over 30% in a matter of weeks, and in crypto, flash crashes are almost routine. But here's where it gets interesting. Bierman isn't just sounding the alarm, he's offering a potential solution. He says the best way for the market to avoid a nasty sell-off is for professional money managers, think big mutual funds and pension funds, to start diversifying into unloved and cheap sectors, basically spreading their bets beyond the high-flying favorites. Let's unpack that a bit. Right now, a lot of money is concentrated in the same few sectors, especially big tech in the stock market, and of course Bitcoin in crypto. But there are entire parts of the market that have been left behind. Think energy stocks, utilities, industrials, or smaller regional banks. Many of these sectors are trading at much lower prices compared to their earnings, what experts call cheap valuations. If fund managers start moving money into these overlooked areas, it could have a stabilizing effect. Instead of all the money chasing the same stocks or coins, you'd have a broader base of support across different sectors. That means if one area gets shaky, others could hold up better, reducing the risk of a dramatic plunge. It's classic diversification. Don't put all your eggs in one basket. There's some historical evidence this works. After the tech bubble burst in 2000, the market didn't just collapse entirely. Money shifted into other areas, like real estate and commodities. The same thing happened after the financial crisis in 2008, when investors started buying up beaten-down industrials and healthcare stocks. Diversification helped cushion the blow. Now, the big question, will fund managers actually make the shift? That depends on a few factors. First, investors have to believe that these unloved sectors really offer value and that the high flyers are getting risky. Sometimes it takes a catalyst, like a surprise earnings miss or a change in interest rates. Other times, all it takes is a few big players making the move and the rest follow. There's also the question of timing. If everyone waits too long, a sell-off could happen before the market has a chance to diversify. But if money starts moving now, it could help prevent the worst case scenario. So, what does all this mean for everyday investors? If you're watching your 401k or crypto wallet and feeling nervous, you're not alone. The key takeaway here is to pay attention to where the money is flowing and to think about your own diversification. Are you too concentrated in just a few stocks or coins? Are there opportunities in sectors that everyone else is ignoring? The bottom line is, markets go through cycles. FOMO can drive prices higher in the short term, but it's rarely a sustainable strategy. Diversification, on the other hand, has stood the test of time. If you found this breakdown helpful, make sure to like, comment, and subscribe. It really helps us reach more investors like you. And before you go, here's something to think about. In markets fueled by emotion, the smartest move is often the one that feels the least exciting. Will this be the moment when diversification becomes cool again? Let's see what happens.